What if you invested $100,000 in VOO instead of SCHD, or vice versa? Let's dive into this comparison. Most people think they know which of these ETFs is the smarter choice for long-term wealth. VOO dominates the news as the go-to for tracking the S&P 500, while SCHD is the steady dividend workhorse. But how does your money actually grow when you put $100,000 in VOO or SCHD and leave it alone for years? Let's explore what makes these ETFs unique and which might better fit your financial journey. Let's start with VOO, Vanguard's S&P 500 ETF, often seen as the bread and butter way to own a slice of the biggest U.S. companies. The S&P 500 is the most recognized index for measuring the U.S. stock market, engineered to mirror the S&P 500 closely. With an expense ratio of only 0.03%, VOO is one of the cheapest ways to invest in U.S. large caps. There's over $1.3 trillion invested in VOO's mutual fund and ETF share classes, indicating strong investor confidence. VOO's portfolio is heavily concentrated in information technology, making up more than 30% of the ETF as of June 2025. Its largest holdings, Apple, Microsoft, and NVIDIA, link VOO's performance to the leading tech titans. SCHD is a favorite for those who value dividend income and defensive investments, tracking the Dow Jones U.S. Dividend 100 Index. It focuses on U.S. companies that pay dividends and have maintained or increased those payments for at least 10 years. SCHD filters out volatile stocks and yield traps, examining financial health with criteria like cash flow and dividend growth. With an expense ratio of only 0.06%, SCHD remains efficient despite double VOO's ratio, offering great value. As of June 2025, SCHD manages $68.2 billion, showcasing the trust it has built with investors. SCHD has a diverse sector mix with 19.4% in consumer staples and 18.9% in energy, differing significantly from VOO. Top holdings include Coca-Cola, Verizon, and Cisco Systems, each contributing around 4.3% of assets, ensuring stability. Over the last 5 years, VOO boasts a CAGR of 15.9%. SCHD clocks in at 12.2%. Over a decade, VOO's growth is 12.8% compared to SCHD's 10.6%. Since its inception in September 2010, VOO's CAGR stands at 14.25%, while SCHD, launched in 2011, has averaged 12.2%. VOO has outperformed historically. If you had invested $200,000 equally in VOO and SCHD in October 2011, VOO would grow to $635,000, a return of 535%. SCHD would reach $485,000, a 385% return. During the COVID-19 crash in March 2020, VOO dropped 33.99%, while SCHD fell 33.37%. Both suffered significant declines. In milder downturns, SCHD's focus on financially solid companies has sometimes led to smaller losses and quicker recovery compared to VOO. Should everyone just dump their savings into VOO and call it a day? Not so fast. There's a deeper insight here. VOO looks fantastic on paper, especially for long-term growth. It's ideal for investors with a lengthy time horizon who'd benefit from compounding. For investors nearing retirement, SCHD is a compelling pick with a dividend yield of 3.92% as of June 2025, much higher than VOO. Both ETFs have strengths and weaknesses that shine depending on where you are in your investing life. Relying on a mix helps cushion uncertainty in financial markets, which go through various phases. Over the past decade plus, VOO has delivered greater wealth, but SCHD offers reliable, growing income and less volatility. Both shine for different reasons, and the right choice depends on your dreams, risk tolerance, and timeline. Combine VOO and SCHD for a mix of growth and steady income. It harnesses the S&P 500's power and disciplined dividends. Don't chase the perfect ETF. Build a strategy that matches your personal financial path and needs. Over the last 10 years, VOO's annualized growth is about 13.1% to 13.8% compared to SCHD's 10.9% to 11.5%. Investing $100,000 in VOO a decade ago would yield over $330,000 to $635,000, compared to about $270,000 to $485,000 from SCHD. Total returns aren't the whole story. The ways those returns are generated and the kinds of risk you absorb along the way are very different. VOO tracks the S&P 500, dominated by tech and growth stocks, which ramped up returns during the bull markets of the 2010s and 2020s. But this comes with a heavier tilt towards sectors that can be volatile in rough times. SCHD takes a value and dividend-oriented approach, holding companies with strong dividend records and robust cash flows. This makes SCHD attractive for investors seeking a steadier ride and dependable cash flow. Risk profiles show only modest differences. SCHD's one-year volatility is about 13.95%, while VOO's is 12%. The real differentiator is risk-adjusted returns. VOO leads on the Sharpe ratio, compensating you more efficiently. This is where SCHD shines, usually boasting a dividend yield above 4% compared to VOO's 1.5%. SCHD's strict selection for healthy dividends means stronger cash flow and lower risk of dividend cuts. Those prioritizing regular payouts over growth often favor SCHD, especially if reinvesting is not their main objective. SCHD is priced conservatively across valuation ratios like price to earnings and price to book, reflecting its focus on value stocks. VOO commands higher multiples, a PE of about 21 compared to SCHD's 13.7, accepted for its superior growth profile. In 2025, VOO is up between 3% and 8%, while SCHD is flat or modestly negative, down up to -2%. The trend fits the post-2020 environment where tech stocks have outpaced the value and dividend sectors crucial to SCHD. During major market downturns like the 2020 pandemic crash, both ETFs fell over 33%. The story deepens when you look at compound annual returns, risk, and income side by side. In a roaring bull market, VOO's tech exposure creates enormous wealth, but incurs severe losses during recessions. SCHD's tilt toward defensive consumer staples and healthcare helps soften losses during market turmoil. Investors needing regular dividends experience smoother cash flow with SCHD, while growth-focused investors are better served by VOO. VOO's expense ratio is just 0.03%, while SCHD stands at 0.06%, both well below the average fund. Younger investors often overweight VOO for its superior growth, while pre-retirees lean into SCHD for higher yield. Some combine both, allocating core growth to VOO while adding SCHD to dampen volatility and boost income, especially as they approach or enter retirement. Past performance isn't always prologue. Over the last decade, tech's dominance made VOO a winner, but market cycles can shift. If value stocks and dividend payers come back into favor, SCHD could close the gap or even outperform. Investors hedge this uncertainty by balancing both funds, reducing the risk of being overexposed to one style or sector. Both funds enjoy massive liquidity and popularity, making them easy to buy and sell at any brokerage. An often overlooked but critical consideration is how taxes impact your returns. Both pay qualified dividends taxed at lower rates. Looking ahead, it's worth reflecting on the psychological aspect of investing. Sometimes the best ETF is the one you can hold through all market conditions without panicking. If SCHD's steadier income helps you sleep better and avoid panic selling, that lower long-term performance might be a worthwhile trade-off. Investors craving long-term capital growth and who can withstand greater swings in portfolio value might embrace VOO fully for higher rewards. Investing $100,000 in VOO provides broad U.S. market exposure, benefiting most when large-cap tech thrives. Expect bumpy roads and lower yield. SCHD offers a disciplined, value-leaning portfolio with strong income and lower volatility, albeit with slower total growth. Both ETFs are robust building blocks. Align your choices with your personal plan rather than hunting for a single winner. Thanks for watching. Like, share, and subscribe if you liked this video. Stay safe, stay curious, and above all, stay human.